You've looked at the spreadsheet, you know the number, and there's a specific feeling that arrives when it crosses a threshold: $500,000, $1 million, whatever the milestone was you'd been building toward. A quiet kind of confidence, not arrogance, just the steady, factual satisfaction of having built something. Now the scenario. Something happens. A business opportunity with a narrow window, a sudden medical cost, a layoff that lands at an inconvenient time, a moment where you need to move real, usable capital, not eventually, not in theory within 45 days. You open the tracker, you see the number, then you start calculating what you can actually touch without a penalty, without a formal application, without a forced sale. And the gap between those two figures is so wide it's almost disorienting. The net worth didn't fail. The structure did. I'm going to show you exactly how that gap gets built, who designs it, who benefits from it, and what the one structural decision looks like that closes it. Not investment advice, not asset allocation, forensic analysis. Here is the belief I'm about to pull apart, and I want to be clear. It's not a foolish belief. It's the consensus. Net worth is the right number to watch. It's the scoreboard every financial planner uses, every retirement calculator runs on, every personal finance education points it toward. Build assets, reduce liabilities, the number grow. This advice is technically sound and directionally rational. And the specific assets you've been steered toward are real assets. Home equity is wealth. A 401(k) or IRA balance is wealth. A stake in a business, an investment property. Equity in a vehicle that holds value, these are not illusions. The accumulation of these assets is how most people with significant net worth got there. The strategy works. Over decades, it compounds. The system has also actively rewarded this pattern of accumulation in ways that are hard to argue with. Tax deductions for mortgage interest incentivized homeownership. Tax-deferred growth in retirement accounts makes the compound math dramatically better than a taxable alternative. Capital gains treatment for real estate appreciation rewards equity holding. The architecture has incentives pointing in one direction. Put your money into home equity, retirement accounts, business ownership, and let it compound in the most tax-efficient structures available. These are not fringe recommendations. They are the default, the consensus, what the certified financial planners, the CNBC segments, the 401 enrollment guides, and the home equity marketing all agree on. You've followed them because they are genuinely well-reasoned within the frame you were given, and that frame has a blind spot. The system taught you to maximize one metric, and that metric does not answer the question that turns out to matter most when something real happens. Here is the test, and I want you to actually run it. Open your net worth tracker. Look at every line item. Now ask a different question for each one, not what is this worth, but how quickly and at what cost can I convert this to cash if I needed to? Your 401(k) balance. If you're under 59.5, early access triggers a 10% IRS penalty on the gross amount on top of ordinary income tax at your marginal rate. For someone in the 22% federal bracket, that combination brings the effective cost of accessing your own money to at least 32% before state income tax. For someone whose income puts them at 24% federal, it climbs higher. According to American Century, income taxes, the 10% penalty, and a potential bracket jump could leave you with barely half of what the account balance says. That $300,000 in your retirement account might produce $160,000 in usable cash if you're willing to pay the price. Your home equity HELOC approval runs 2 to 6 weeks from application to funding, according to data from multiple lenders including Chase and SoFi, and that assumes good credit, no appraisal complications, and underwriting income that still exists. If you need to sell the property instead, Zillow's August 2024 data puts the national time from listing to closing at 69 to 86 days, and the transaction costs on the sale run 8 to 10% of the sale price according to Zillow, and multiple real estate data sources, agent commissions, transfer taxes, title insurance, settlement fees. On a home with $400,000 in equity, you give back $32,000 to $40,000 before the remaining equity hits your account. Your business stake, If the ownership is in a private company, there is no market, no terminal. A liquidity event requires a buyer, a transaction process, and a timeline measured in months, not days. The equity is real. The access is theoretical until it isn't. The crack isn't that you built the wrong things. The crack is that you may have been running a single metric optimization on a two-dimensional problem, and the second dimension only announces itself when something specific happens. The mechanism has a name: asset illiquidity design, and it doesn't operate through deception. It operates through incentive alignment, a structure where every financial incentive in the system steers you toward the same category of asset, while the limitations of that category are nowhere in the risk disclosure. Let's trace the origin. The retirement account lock is not incidental. Congress designed the 10% early withdrawal penalty specifically to keep capital inside retirement vehicles until the designated drawdown period. The tax deferral is the carrot, the penalty is the lock. The system generates two fiscal outcomes: higher current savings rates, which increase investment industry assets under management and delay the taxable event, followed by mandatory distributions beginning at age 73, which begin a long, predictable tax collection period. The lock isn't a flaw in the retirement savings system. It was built in deliberately by people with distinct fiscal interests in the outcome. The home equity structure operates on a separate track with a similar effect. The mortgage interest deduction, in its original form, made homeownership financially rational beyond its actual return on capital. This drove household wealth into a specific illiquid asset class for generations. The Federal Reserve's survey of consumer finances, analyzed by multiple financial researchers, shows that home equity represents more than half of total net worth for middle-wealth American households, those roughly in the 50th to 90th percentile range. Half of the reported wealth of the households who most faithfully followed conventional financial planning, sitting in an asset that requires 69 to 86 days to liquidate and 8 to 10% in transaction costs to access. Here is the mid-script plant. What is the number that actually matters, not the balance? The accessible balance, the amount you can reach without a significant tax event, without a formal waiting period, without a forced transaction at a moment not of your choosing. That number, for most high earners who followed the consensus strategy, looks dramatically different from the headline. Who profits from the illiquid structure? The mortgage origination industry collects fees, servicing income, and 30 years of interest on home loans that were made more attractive through tax incentives. The real estate transaction industry earns 5 to 6% on every sale event, both when you buy and when you eventually access that equity. The HELOC market charges interest to give you access, through a formal credit application, to equity you already built. The retirement fund industry earns expense ratios on every dollar in every account for every year it stays locked inside a managed fund structure. The financial planning industry earns advisory fees to manage complexity that exists, in part, because the assets are illiquid and require navigation. Each party in this chain benefits from the architecture that keeps your wealth inside specific structures. None of them designed it with malice. The incentives aligned over decades around a set of products that generate revenue most efficiently when capital stays put. And then there is the cultural frame, which reinforced the structural one. Liquid assets are irresponsible. Cash earns nothing. A taxable brokerage account is inefficient capital that should have gone into the 401(n) first. An emergency fund larger than 3 to 6 months is capital sitting idle. The messaging around financial responsibility was built around maximizing illiquid accumulation, and the institutions that profit from illiquid structures had significant influence over what responsible finance was supposed to look like. Here is how the same discipline, the same income, and one structural decision produce two completely different outcomes at year 10. These are constructed characters, not case studies built to isolate the mechanism. Marcus and Elena, both 38, both carrying combined household incomes of $220,000, both financially disciplined for a decade, both hold mortgages in the $550,000 range. At 38, both find themselves with $20,500 per month available to direct toward asset building. Every financial advisor they consult gives roughly the same answer. Max out retirement accounts first, then accelerate the mortgage, then invest what remains. Marcus and his partner follow this exactly. They contribute the maximum to their 401ns $23,000 each for 2024. Then they direct an additional $800 per month toward mortgage principal paydown. The remainder, around $300 per month, goes into a small taxable account. Elena's household makes the same 401 nen. Maximization, the tax deferral is too valuable to leave, but instead of the mortgage acceleration, they make the minimum required payment and route that $800 per month into a taxable brokerage account in low-cost index funds. Same income, same discipline, same monthly surplus. One line item allocation different. 10 years later, at 48, the spreadsheets look close but point different directions. Marcus carries approximately $1.55 million in net worth, $320,000 in retirement accounts, $680,000 in home equity on a nearly paid down property, $180 seen in the taxable account, $370,000 in other assets, including a partial business stake. Elena's net worth is $1.22 million, $310,000 in retirement accounts, $380, zero in home equity with more remaining balance, $460,000 in the taxable brokerage, $70,000 in liquid savings. Marcus's number is higher by $330,000. By every conventional metric, Marcus built more wealth. Now the function test. Both face the same event at 48. A layoff plus a business acquisition window that requires $280,000 in accessible capital within 45 days. The kind of moment that arrives without scheduling. Marcus starts calculating. His retirement accounts hold $320,000, but early withdrawal before 59 and a half would cost him roughly 32 to 38% in combined penalty and taxes, reducing the effective access to somewhere between $109,000 and $218,000, and it permanently collapses the retirement position he spent 10 years building. The home equity is real but not available. HELOC approval requires underwriting income, which just went to zero with the layoff. Selling the house is not a 45-day transaction. The business stake is illiquid by definition. His taxable account holds $180,000 accessible, but $100,000 short of the threshold, with no clean path to close the gap in the window. Marcus has $1.55 million on paper. He can reach approximately $180,000 within 45 days without triggering a major destructive event. He misses the window. Elena's calculation takes minutes. The taxable brokerage holds $460,000. All of it accessible inside 48 hours, no penalty, no application process, no appraisal, no underwriting income requirement. She liquidates $280,000, covers the opportunity, and retains $180 in liquid reserves. The same event that closed Marcus's window becomes an event Elena was structurally positioned to meet. Same discipline, same decade of building. One structural allocation decision made at 38, repeated at $800 per month. Marcus didn't make a mistake. He followed the consensus correctly. But the consensus optimized for the first metric, the number on the spreadsheet, and left the second metric untracked. Multiply this by 10 million. According to the Federal Reserve's Survey of Consumer Finances, for middle wealth households in the 50th to 90th percentile range, home equity alone represents more than half of total net worth. The Investment Company Institute reported in September 2024 that over $42 trillion sits inside retirement accounts, and a third of all Americans' financial assets are locked inside tax-deferred vehicles with access restrictions that make them unavailable without cost before the designated age. For the median American household, the Federal Reserve reported total liquid financial assets, the figure that excludes home equity and tracks checking, savings, investment accounts, and retirement account balances together at approximately $39,000. Not $39,000 in truly accessible liquidity. The total financial assets, its figure that most households could navigate with least friction across all forms, is meaningfully lower. The headline net worth figure, the one used to benchmark financial health for the same median household, was $192,100 in 2022, per the same Federal Reserve survey. The gap between the headline and the function is documented, consistent, and structural. Note, these are aggregate median figures. Individual household compositions vary significantly by income, age, and asset allocation choices. Now consider what this architecture produces at scale, not in a crisis but in ordinary life. Households with $600,000, $900,000, $1, $3 million in reported net worth may be operating on accessible capital of $80,000, $100,000, $200,000 without triggering a costly transaction or wading through a formal application. The rest is real. It is documented, it compounds, it will eventually be accessible. But it is not available on the timeline that a career disruption, a medical event, a business opportunity, or a family emergency actually runs on. The illiquid trap is not most severe at the extremes. It is most severe in the 40s and early 50s peak earning years, peak career exposure, peak family financial demand, old enough to have built significant equity, not old enough for retirement accounts to be accessible without penalty. The system's lock is at its tightest precisely when the demand on your resources is at its most complex. This is not an accident of design. It is the design. Net worth is a balance sheet metric. It answers a bookkeeping question: what have you accumulated over time? It is valuable for estate planning, for comparison to benchmarks, for measuring long-run progress. What it does not answer is a different question. What can you do in a specific window, with a specific opportunity, or a specific crisis? That second question belongs to a different metric. The financial system didn't teach it to you by name. It's liquid net worth, the sum of everything you can convert to usable cash within 30 days without a significant penalty, a formal credit application, or a forced sale at a moment not of your choosing. For most households in the 50th to 90th percentile, liquid net worth is dramatically lower than reported net worth, not by a small margin, often by 60 to 80%. The gap is real, documented by Federal Reserve data, and most households have never been asked to calculate it. Here is the reframe, not an investment strategy, but a frame. Wealth has two dimensions that the spreadsheet renders as one. The first is accumulation. How much have you built? The second is access. How much of what you've built can you actually reach? The financial industry teaches the first dimension almost exclusively because the first dimension is the one that maps cleanly onto the products it sells: mortgages, retirement accounts, managed funds, real estate. The second dimension maps onto a product category that generates much less revenue: cash, taxable brokerage, liquid assets with no lockup. This does not mean the first dimension is wrong to pursue. A 401(n) compounding for 30 years at pre-tax rates produces significantly more than a taxable alternative with the same contribution. That math is real and remains worth following. Home equity is real wealth. The point is not to dismantle the structure. The point is to know the second number, to calculate it deliberately, annually, and to treat the ratio between accessible capital and total net worth as a design constraint you're choosing, not a side effect you inherit. The households that pass the function test aren't the ones with the highest headline number. They are the ones who built with both dimensions in mind. Who asked, at the same decision point, Marcus and Elena faced at 38, not just what is this asset worth over time, but when can I reach it, and what does it cost to get there? Elena's counter-architecture wasn't a radical departure. It was one allocation shifted at one decision point. The 401(n) was still maximized. The mortgage still got paid down just on schedule, not accelerated. The $800 per month went into a different asset class with a different access profile. Same discipline, same income, a different question asked. That question is available to anyone who knows it exists. Your net worth is what you've built. Wealth is what you can reach. Most people spend a lifetime working on the first number without ever calculating the second.